You paid your insurance premium last Monday. The company won't actually cover you until Friday. So for 4 days, who owns that money? Technically, you sent it, technically, you're covered. But the cash is sitting in an account earning interest, and it isn't yours anymore. Welcome to the float. The float is one of the most quietly profitable mechanisms in all of modern finance. It's not a scam, it's not illegal. Most of the time, it isn't even hidden. It's just that almost nobody talks about it, and companies who earn from it would rather keep it that way. What float actually is. In financial terms, the float is the money that is in transit, technically sent by one party, not yet received or deployed by the other. During that gap, the money exists in a kind of a financial limbo, and whoever holds it during that limbo earns it. Think of it this way: every time you pay for something, a subscription, a deposit, an insurance policy, a gift card, there is a window of time between when the money leaves your control and when it actually is used. That window might be hours, it might be days. At the scale of millions of customers, even a 48-hour gap becomes a staggering amount of idle capital, and idle capital earns interest. Warren Buffett built part of Berkshire Hathaway's fortune on something he openly called float, the gap between insurance premiums collected and claims paid out. He described it as being paid to hold someone else's money. Where do you encounter it without knowing? First of all, gift cards. In India and globally, gift cards are one of the purest float plays in existence. When you buy a 2000 rupee gift card, the retailer receives 2000 rupees immediately. The card might sit in a drawer for 3 months before it's redeemed, if it is ever. During that entire time, the retailer holds and earns on that money, and roughly 10 to 15% of gift cards value is never redeemed at all. That's called breakage, and it goes straight to the company's profit line. Second is insurance premiums. Insurance companies collect premiums months or years before more claims are filed. An annual health or vehicle insurance premium paid in January might fund a claim in October, but for 9 months, the insurers hold and invest that money. Berkshire Hathaway's insurance operations alone had over $160 billion in float by recent counts. Buffett's genius was recognized that if you underwrite well enough, you effectively get paid to borrow money. Thirdly, payment processors and wallets. When you load money into Paytm, PhonePe, or any digital wallet, your money sits in a nodal account before it's actually spent or withdrawn. Regulations in India require that this money be held in escrow, but this aggregate balance across millions of users enormous, and the internet it earns flows to the payment company. When UPI transactions settle, there are also micro delays in interbank clearing, during which vast sums sit in transit. Security deposits. You give your landlord 2 months of rent as a deposit. That might sit with him for 1, 2, or 3 years. In most Indian states, landlords are not required by law to pay you interest on that deposit, even though they can freely earn on it. You're effectively given them free interest loan for the duration of your lease. Salary timing. Most salaried employees are paid at the end of the month for work done throughout the month. Day 1 through day 30, you have delivered your labor, but your employer holds your wages as working capital during that window. At that scale of a company with 10,000 employees, the difference between paying on the 1st versus the 30th can represent significant float income, or at minimum, a meaningful reduction on their own borrowing costs. Suppose a company has 50,000 customers, each holding an average balance of 3,000 in a digital wallet. That's 15 crores sitting in a non account. At even a conservative 5% annual return, that's 75 lakh per year, earned entirely from money that isn't theirs, doing nothing visible. Why this matters more now? Float has always existed, but two things have turbocharged it in the modern era. First, digital payments created entirely new categories of float: wallet balances, subscription fee billing, and instant debit, but slow settle systems that weren't possible with cash. Secondly, when interest rates are high, as they have been globally over the past few years, the earnings on float balances increase sharply. The same idle 100 crores add far more at 6% than it does at 1%. This is why some fintech companies that appear to make no money from fees are in fact highly profitable. The business model isn't about the fee you see, it's about the float you don't. The float is a hidden subsidy that flows from people with less financial sophistication to institutions with more of it. You participate in every day, almost nobody told you. What you can actually do. On gift cards, use them quickly. Every day you wait is a day the retailer earns on money that was meant to be yours to spend. If you receive gift cards as a gift, treat them like cash. Deploy them fast. On deposits, negotiate interest on security deposits whenever possible. In some states and jurisdictions, you may be legally entitled to it. Even when you aren't, landlords who value good tenants are often willing to agree to it upfront. A signed clause in the lease agreement is worth far more than a polite conversation at the end. On wallets and on subscriptions, don't maintain large idle balances in digital wallet unless there's a genuine reason. The convenience is real, but so is the float. You're gifting. Similarly, be conscious of annual prepayment deals that ask you to pay 12 months upfront at a discount. Sometimes the discount is real, sometimes it's covering what they earn by holding your money for a year. Salary, this one is harder to act on. Salary cycles are structural, but understanding it reframes what it means to have money saved versus money simply waiting to be paid to you. Keep that float part in mind when managing your personal liquidity. The float isn't malicious. It's a natural consequence of how money moves. Asynchronously in batches through systems with delays, but recognizing it changes how you see the financial world around you. Every subscription, deposit, and prepayment is also a small, quiet loan you're extending to a business. The only question is whether you're getting a fair return on it or whether they are.